Hi everyone, this is a short screencast for F6 Taxation IRE for the mock exam in May 2015. I'm going to focus in this particular screencast on section A and the short form questions. So question 1 here relates to the 2/3 rule and VAT. So we've got an individual called Paddy who's raised an invoice, and we should be able to see from the question that this invoice is for repairs to movable goods, and this would be the sort of the typical example here, a dishwasher. And what we're really required to do is to establish what rate of VAT will apply to each of the individual elements that make up this particular invoice. And obviously in this case, and this would be the way that your examiner would come at it, we've got labor and we have parts. Now I think the key trick here is outside of which rate do we apply, 23% or 13.5. The key trick here is to note that when we're doing the comparison and looking at the element of cost, we're looking at the cost of the parts to Paddy. Yeah, so this element here. So we're really looking to say, out of this 172.20, what's the net cost to Paddy? Notice that we do have a cost of parts here that's charged on to the customer, but that's not the one that we use for the 2/3 rule. So we'll see when we look at the answer that in effect what they do is they say, well, what's the cost of the parts to Paddy? Let's net them off and then let's compare that to the overall cost. So if we look at the answer here, we'll see that the X cost, the X VAT cost to Paddy is actually 140, and that's simply the 172 really scaled back to exclude the 23% VAT. So it's only at that point that we can then apply the comparison. So we would take that net cost, i.e. the 140, over the total amount given in the question, and we get 47. So 47%. So as we can see, that 47% is less than 2/3. So what do we do? Or in that case, as we see over on the left-hand side here, we apply the 13.5% rate. In other words, the rate relevant to the repairs service rather than the parts. Had it been over 2/3, we would have applied the rate relevant to the parts, which is 23. Okay, so the answer in this case, as we'll see, is 40.50. Okay, so that's a 2/3 rule. Very, very common in the F6 exam in one way, shape or form, perhaps in a long form question, but here within a short form. Okay. Next area here is ethics. Again, a popular area, and I sort of draw your attention to our ethics mnemonic. Yeah, so confidentiality, objectivity, professional behavior, professional competence, and integrity. And really all that they're doing within this question is giving you an example of 4 different ones and trying to make you pick out what the one that relates to professional behavior is. And that's very much, albeit for the fact that the word behavior is mentioned in B, it's very much just acting properly, complying with regulations and indeed laws. As I've noted, the other ones, A, C, and D, are several of the other elements of the professional code. So that one's a little bit of a gimme question. We should be familiar with ethics. Again, could appear in a long form question, perhaps with a bit of narrative. I think this is what we need to be aware of, that mnemonic for each of the elements. Okay. Next one here relates to residency, and again quite a popular little topic within F6. We're asked to establish which one of the following individuals is resident in Ireland for tax purposes, and hopefully we'll be aware of the fact that there are 2 main rules for residency. There's just the standard 183-day rule, and then there's what we call the look-back rule, which relates to an overall number of days being in excess of 280 in the current year and the previous year, with more than 30 in the current year. So just looking down them here, we'll see that A for Paddy is certainly less than 183 days, therefore that individual is definitely not resident. John B is less than 183 and indeed less than 280, so certainly not relevant and not resident in either year. C is in fact the answer. I'll come back to that in a second. We see that Mary in D, she leaves Ireland early in 2014. She had lived in Ireland all her life, so in fact, you might have been drawn to that question in terms of the fact that there was a large number of years in the or a large number of days in the previous year, but unfortunately, she's not in Ireland for more than 30 days in the current year. Yeah, in 2014, only 20, and therefore the look back rule doesn't catch her. Okay, now C is in fact the answer, and the reason for that is simply that in 2013, Joe had 173 days, in 2014, 120, so we can see that for the look back rule, that's certainly in excess of 280, and obviously it's in excess of 30 in the current year. So do be familiar with both of those rules, particularly look back. I think that's a little bit more tricky to work out, and if I was examining this area, that's certainly something that I would target rather than the standard 183 days in the tax year. Okay. Next question here relates to BIKs, again a popular little area. They've done the standard trick here. They've included an individual who has a BIK or indeed a car for only part of the year. So when you're looking at BIKs, always look out for short periods. That's got to be a trick that the examiner is going to play. And outside of that, certainly contributions. So I always talk to students in classes where we're talking about benefits in kind. Watch for short periods and contributions. Is if those two things, or at least one of them, aren't in the question, there's something probably wrong with the question. Okay, so we had a short period. Looks like the car was only available for 6 months of the year, so I'm thinking 6/12. We have another little curveball here in relation to the value of the car. Now, really for BIKs for cars, we're only interested in the OMV, yeah, the original market value, and that is 40 in this case. And I'll take you through the answer in a moment. The other problem that we have, noting that obviously the 30k amount was, as I've said, just a red herring. And the other issue that we have is just really the number of business mileage, the number of business miles. And note that obviously if we have large business miles, we're looking to go to really the tables and pick up perhaps a reduced percentage based on those miles. So we have 13,000 business miles. We really need to see, given the fact that it's a short period and indeed the OMV, what's going to be relevant in terms of BIK. So if we look at answer 4 here, what we'll see is, there we have the 13,000 business miles. What we've got to do is to inflate them, or indeed to annualize them. So if we annualize them, given the fact that they are in effect incurred over a 6-month period, we're going to get to 26, and that's what we compare within our tables. And when we look at the tables, we'll see that based on that annualized business mileage, we've got 24%. So what do we then do? Well, certainly we apply that percentage to the OMV. We get a figure note for a full year, and we've got to cut that down. So we've got to cut it down by 6/12, given the fact that BIK was only relevant for 6/12 of the year. Okay, so that's a good little BIK question that covers quite a few of the things that you would expect, and the answer for that is A. Just remember, short periods and contributions, we're always watching out for them. Okay, this next one, just a little bit of admin. I won't spend too much time on this. I mean, certainly with admin in the F6 syllabus, as I've said in classes, let's spend little and often time just sort of rote learning. In this particular case, they're asking for preliminary income tax, excuse me, for 2014, and that has to be on the 31st of October. Okay, so don't forget your admin. Won't be a large amount of marks in the paper, but to a large extent, no technical competence required, just really rote learning. Okay, so answer C in that case. Next one, number 6 here, we have a PRSI calculation. So I certainly think with PRSI and with USC, just learning that formula to establish what's relevant and what isn't, and what's included, what can be deducted. In this particular case, we'll see that, in fact, the salary is definitely relevant. The deposit interest is certainly relevant, but pension or a pension deduction is not going to be relevant. Okay, so if we look at the answer here, we'll see that all that they've done is take the salary, really gross up the dirt for 100 over 59, given that it's paid net, and then just simply apply the 4%, giving us the 3,000, and certainly ignore the pension, as I've said. So number 6, answer D. Next point here, again, popular little area. Your F6 examiner loves cars in all respects, and in this particular case, we're looking at a limited company that's leasing a car for its CEO. And again, note that the date here, 1st of June, so it's sort of been cut down. I think, in fact, it shouldn't be 6/12, it should be 7/12 there. So we've got an annual rental here of 6,000. We've got value of the car at 38, and we can see, or we should be able to see from the tables, that this is a Cat A car. Now, they've used this private purpose or private use percentage. Again, when we see this with limited companies, we should be aware of the fact that for a CEO who is employed, really the private usage is not overly relevant. What we're looking to do is to assess that individual for a BIK on the car, given that he's using the car for private purposes. So this question tested quite a few little things, and the key point, I guess, is what is the add back given the details above in the question. Okay, so if we look at the answer 4/7, we'll see that in fact they have used 6/12, so I think that's an error given the fact that it should be from 1st of June. So perhaps the answer is wrong. I think it is. But anyway, let's concentrate on the principles of it. So what we've got is a lease cost, they say, for 6 months. We've got 6/12 times the full lease cost. So in other words, that's the amount that's being charged in total. So what we're looking to do based on a Cat A car is see how much of that is actually going to be added back in the computation. And for a Cat A car, we should be aware of the fact that we simply slot in the full value of the car, take off 24, and then divide by 24, and that's how we get the add back. Okay, so apologies for that little error there in relation to the date, but just watch out for which category the car is in, get the right formula, and then just add back the relevant amount. Okay, so next one here is 8. A little bit of a tricky question here, quite a lot of detail in relation to this interspouse transfer. I mean, I guess in the first instance, what we've got to be aware of is the fact that disposals between spouses more often than not are exempt for CGT purposes. There will be no gain at the time of the disposal, no charge to CGT. Quite a lot of information given here, and I think the key point is that there will be instances where the married exemption or the spouse exemption will not be available. So a little bit of rote learning there. Certainly the other ones are totally correct. It's just that C, that in certain circumstances the CGT exemption will not apply. Okay. Number 9 here, this is the termination rules, and this is something that confuses students from time to time. We know that we have those 3 exemptions for termination payments, 3 calculations within our tax tables, and this particular question concerns 2 of them. So we've got an individual who's made redundant and has been employed for a period of time, 12.5 years. They've given us some details on a statutory redundancy payment and an ex gratia payment, and some average emolument. So if we know our termination payments rules, we know that the SCSB is certainly going to be relevant here. In fact, each of them are. Each of the 3 termination formulas that we have within our tables are going to be relevant. Now, I think the key point is that we should always be aware of the fact that statutory redundancy is going to be exempt in all cases. Other than that, we've got an ex gratia payment. When we see that, we've got to think that ex gratia effectively means something that is going to be partially exempt, i.e. this 42,000 is going to be included within our calculations. They give us the average emoluments. Note to the date of termination rather than to calendar years previously. That's a common trick in long form questions. And in addition to that, they give us a pension lump sum. And note the size of the pension lump sum. In other words, it's in excess of 10,000. So with our three different termination formulas, we sort of should be aware of the fact that, in fact, the second one, in other words, the increased basic, is going to be exactly the same as the basic exemption, because the additional 10K is not going to be available because the pension lump sum is in excess of the 10K. Okay, so if we look at the answer here for 9, what we're going to see is that, in fact, all that they do is just really look at the two exemptions, i.e. the basic. They discount the increased basic because of the high pension value, the pension lump sum, and then they apply the SCSB formula. Now remember, this information is in your tables, so really there's no excuse for having a reasonable bang at this question. The basic exemption, we know that it's 10160 and then just 765. Notice complete years, so it's the complete years, don't include any part years. So we get 19K or thereabouts for the basic. The SCSB, again, note complete years, and again, formulas in the table. Really, what we're looking to do is to just really slot in the figures, and let's get those figures right. So based on the two, we have 19 for the basic, 32K for the SCSB. So what we can see is that certainly the taxpayer will choose the higher one. So really what we're looking to do is to say, okay, what are the value of what we call partially exempt payments? In this case, you'll recall that we have an ex gratia payment of 42. We're completely discounting statutory redundancy because that's completely exempt. Okay, so that's not going to figure in our adjustments, as it were. So we're just taking anything that is ex gratia. We're taking off the highest of the three, in fact the two in this case, and we're getting to 9.3. So you'll see that in our answer, the taxable, or the amount of the taxable termination payments, is the answer D. Okay. Next point. We have a CT and losses. Now, I do think there's an error in this question. Really what we're looking at is a company that has a loss in a given year. We'll see 31st of December 2014, 600K. Now, we should know that with companies that there is a 12-month carryback facility so that we can relate the loss back 12 months. Now, notice the dates, or indeed the time periods here. We've got a year for the loss, we've got 6 months for the preceding period, and we've got a year for the period preceding that. Now, the way that I read this is that we can certainly go back the 6 months, that's okay, and that gets rid of certainly 400K of the loss, and I see that we can go back a further 6 months. So we're going back 12 months in all. I make 6/12 of 250,125. The answer is actually D in the answer booklet, but I make it C. So what we're looking to do within this question is just basically say how much of that loss are we able to go back on, and I make it 6/12 of 250 being 125 rather than the 200. Okay. Next one, number 11. We've got an error here as well, I believe. We've got a company that is owned by 4 individuals. We've got a dividend being paid out to each of the individuals, and in effect they've got slightly different circumstances. Now, the way that I see it is that where DWT is going to be payable in respect to the dividends, it's going to be basically for any Irish resident individual, and that would make it these two for me. So in fact the answer is B in this case rather than A. As far as I'm concerned, certainly an individual that's resident in Ireland will have DWT, whether or not they're domiciled or not, they'll have DWT deducted from them. Certainly an individual resident in the UK will not, because it's an EU DTA country, and a company would never have DWT deducted from it. Okay, so the answer is in fact B rather than A. Now, next one here is our USC calculation. You remember the little question that we have above in relation to PRSI. So really it's a question of, what do we exclude and what do we include? And the key thing I think for USC to remember from this particular question is that the DIRT is going to be excluded. So we've got salary, we've got rental income, and we have Irish dividends. And we'll see when we look at answer 12 that basically DIRT is excluded from that calculation, only the salary and the other items, and also the pension deduction also never included within a calculation for PRSI or indeed USC. So the answer in this case is B3986. Okay. Next point here is just a sort of an unusual question, I guess, in relation to this home improvement or home renovation incentive scheme. Not something that you would see very, very common. And really what we're looking to do is to establish what is the credit available to this individual who's qualifying in relation to work done on his PPR, his principal private residence. The question specifically asks us for what is the detail in respect of the tax credits that may be available. And I guess the key thing to remember is, this home renovation incentive scheme really does provide a credit of 13.5% in total over 2 years. But note that that credit has to be paid to individuals who are really up to date in relation to other taxes, in particular LPT and household charge. So certainly going to be eligible on that basis. If we look at the answer, you'll see 413, excuse me, so that is available at 13.5% on the VAT exclusive cost, and it basically phased in the year after the work is carried out for 2 years. So if we look at the tax credit of 1485, you'll basically see that that is in fact phased over 15 and 16, albeit for the fact the work was incurred in 2014. Okay, quirky little question there, not so common. Okay, next question, number 14. We've got averaging here for farmers, and it's a fairly straightforward issue, averaging, and perhaps it's an issue that students find a little bit unusual and perhaps don't spend enough time on it. This is probably your sort of worst case scenario, because rather than simply asking you to provide an assessment based on the farmer's averaging rule for a year, what they do is that they ask you to consider a situation where the individual wants to revert back to the normal basis, and there is a little bit of work to do there. We've got basically what I would call a sort of an exit issue. And if we remember with averaging that essentially what we're looking to do is basically take 3 years and divide them by 3, and we're going to get the correct figure. This particular question, as I've said, goes further, and it asks us for what the revised assessments are in relation to an individual who's looking to opt out of the averaging basis. And I'll take you through the answer in a moment, but I think what we've got to do is just be careful on the years. He's looking to opt out really for 2015. In other words, that would be the first year that he would revert to the normal basis. Now, where we get that situation, we've got to go back to the previous 3 years, so 14, 13, and 12. Okay, so just note that. So if opting out in 2015, it's the 3 years prior to that that we need to look at. And what do we need to do? Well, we need to basically say, what was the assessment for his final year? Now, these numbers here, although it looks a little bit confusing, are simply the 3 years. The 3 years in order. Note that the loss there is included. It's just deducted. Okay, so we've got a 2014 year. That's his final year of averaging. And the assessment for that, as you'll see, is 7,000. Now, what happens is that the 2 years prior to that, so the 2 years prior to his final year of averaging need to be looked at. And really they need to be looked at to assess whether or not they are higher or lower than the 2014 year. And if they are lower, the assessment has to be revised upwards for each of the years. So if you look at the assessments, again, these figures are just given in the question, you'll see that 2012 was okay because it was higher than 7,000, but 2013 wasn't okay because it was lower than 7,000. Therefore, the final, or indeed the revised assessment for 2013 has to be 7,000. Okay. Right, next point is indeed our final question, I believe. The answer in this case for 14 was just part B here. You'll see a revision upwards to 7 for 2013, no revision for 2012. Okay. Now, this final one is just in relation to capital allowances augmenting an income tax loss, and hopefully we'll be sort of familiar with the legislation and indeed the ability of capital allowances to certainly create or indeed increase a loss under Section 381, in fact, Section 392. Okay, so B is the answer in that case. Hopefully that's been helpful to you, and good luck with your studies. More videos to come in relation to each of the following mock exam questions. Many thanks.